Hey, this is Jordan. This video is being recorded on the afternoon of Tuesday, October 18th, 2022. Thank you so much for joining me today. In this video, I am going to answer the question, when will gold decouple from the stock market? And I've been talking about this even since earlier this year. So I did make an error earlier this year. In the first quarter, it looked like precious metals were decoupling from the stock market. And then everything started falling together in earnest after the first quarter when the bear market really kicked in. So I'm going to go through some history here and analyze and discuss when we're going to see the decoupling and how that might take place. Okay, so first in this chart we have the S&P in black, and then we have gold in gold, and the vertical lines there show points when there was a decoupling, or it was a period where gold performed really well and the market itself performed poorly. So not necessarily a full-blown, full-scale decoupling over the entire time, but a period when gold performed well and the stock market didn't. And so everyone obviously knows about the mid-70s, and that was the period in which you had a full-scale decoupling there in the mid-70s, the 72 to 74 period. If we're looking at the 6 mega bear markets, and if we're obviously 2 of those were during the Great Depression. So if we're looking at the 4 mega bear markets, that was one of the 4 where there was a full-scale decoupling. And so we can see from 1971 through 74, gold performed really well. The stock market did not. And, that inverse correlation continued when gold had that infamous 45% decline over, I think it was 18 months or 20 months or so, 75 to 76. So they were decoupling at that time, but obviously that was negative for gold. And then 1977 to 78, that's when gold really rebounded. The stock market had a 20% decline then. And then when gold went parabolic, they both went up a little bit. But anyway, you go back to 71, 72 through 77. I mean, for the most part, they were inversely correlated. Then you look at, obviously, the 2000 to 2002 period. This is one I should have studied better, because in the past, I just assumed it was really a full decoupling, but it really wasn't. It was really, well, for the stocks, it was a decoupling, because the stocks bottomed in November of 2000, and then gold began its bottom in February of 2001. It made a double bottom. So if we're looking at gold, it took 11 months into that bear for gold to bottom, but for the gold stocks, it was only 8 months. And then actually more recently, if you look at 2018, 2019, 2020, they weren't inversely correlated the entire time, but actually gold bottomed in 2018. That's when the stock market itself made a peak, and then it had a decline. I think that might have been close to 20% there. Then the market recovered. Then you had the COVID. And so, during those 2 years or so, gold did really well. Gold stocks did well. But the market did not perform as well because of the negative / inverse correlation there at the beginning. So these are some historical examples. Now, looking at this chart, this is going to better answer the question. And so looking at, it's really interesting. You can see the 3 boxes there. So other than during the mid 1960s, the best performance for gold and more so gold stocks really came during the expansion after the secular bear market began. So what I mean by that is secular bear market begins in 1929. Then you have the economic expansion from 32 to I think 37. Gold stocks, they started performing I think 1930 or so. I mean, that's a basket. It's not the Barron's Gold Mining Index. That starts in 38, but there was a basket of stocks, a different index that I tacked onto it. But anyway, you can see there, gold stocks perform really well. Then, the second best example is in the early 2000s, which I just talked about. You can see, obviously, gold stocks late 2000 to 2007. Most of that performance came during that '03 to '07 or '02 to '07 expansion. Now, the early 70s was a little bit different, but, gold stocks and gold, they did perform decently there at the beginning of the expansion, but then most of the best performance, that was actually the negative correlation when the market fell apart there. So what I'm getting at, I'm getting at what happens after the negative correlation or the inverse correlation, and that's when if we're looking at the next couple of years. Let's say the recession ends at some point at the end of 2023. The stock market bottoms in the middle of 2023 or, whatever, pick your dates. And if there's an economic expansion for a couple years, that is going to be the period when gold stocks and probably silver especially will perform really, really well. However, they're going to, gold and gold stocks especially, they're going to bottom obviously before the stock market does, and well before the recession ends. And so if we're looking at the 6 major bear markets, we'll forget about the first 2 during the Great Depression, but if we look at those 4, so we have 1968, 1973, 2000, 2007. So we have those 4. 1973, that was when there was a complete negative correlation. So if we look at the other 3, what happened after the 1968 bear? The bottom in gold stocks was basically 12 months after the bear market in the S&P began. If we look at 2000, the bottom in gold stocks was 8 months after the bear began. Bottom for gold was 11 months after the bear began. And if we want to throw 2007 in there, the bottom was in October. That was 12 months after that bear began. And, there were really significant rate cuts in September. I believe the month before the bottom, everything really started falling apart. That's when they cut rates from 2% down to 0. They had paused for several months. So that was an important catalyst. And at the same time, if we're looking at those other bottoms in 2068, rate cuts were also involved. So as far as when are they going to decouple, my thinking is I don't think it's going to be when the Fed cuts rates. I think let me stop for a second. I do think they will decouple when the Fed cuts rates. However, I think we're going to see the bottom when the Fed stops hiking. The Fed should stop hiking in the next couple months, maybe after November, probably after December at this point. So the Fed stops hiking then you get a bottom in the sector. But when the Fed is forced to cut rates, probably in the first half of next year, it's going to come sooner than everybody thinks. They'll end up cutting rates from 4.5% or 4% down to 2 or 2.5%. That's what's going to happen. So when the Fed is forced to cut rates because everybody knows we're in a recession, and the market discounts that, and you see the S&P falling below 3,500 towards 3,200, maybe even lower than that, that's when you're going to see the decoupling. Because the economy going into recession, everybody realizes it, the market trends lower, makes a lower low, then the markets force the Fed to cut rates. That's when you get the really strong decoupling. So we should see a strong decoupling at some point in the first half of next year. I believe the bottom will come a little bit before that. But again, you get the decoupling in the first half of next year. And then at some point next year, maybe it's next October, that's when you see the ultimate, bottom in the stock market. And then as you can see here, you look at the 3 boxes, then you could get something like that after the stock market recovers, or at least for the last, the move begins before that, as I already said. So that's my view. I know that's a lot to take in, but those are just my thoughts on the decoupling right now. Let me know what you think in the comments, and stay tuned. I'll have more videos coming in the days ahead. Thank you.